What if I told you that a significant chunk of a global economic powerhouse isn't owned by its own citizens? That nearly a third of its most vital financial arteries are controlled by outsiders? Welcome to Japan, where foreign investors now hold an unprecedented 32% of its entire stock market. From just 5% in the 1970s, this isn't just a slight increase. This is a quiet, yet monumental shift of power. But what if this isn't just a Japan story? What if this trend of foreign entities increasingly owning the very fabric of national economies is happening everywhere? Why does it matter who owns a piece of a country's wealth? And why should you care about the silent takeover of global stock markets? To understand this modern phenomenon, we have to rewind and look at Japan's unique journey. For decades, its economy was a self-contained marvel. Post-World War II, it rebuilt itself with astonishing speed, fueled by domestic savings and a unique corporate structure where extensive cross-shareholdings between Japanese companies were the norm. This created an insular, protective market where foreign influence was minimal. Foreign ownership remained incredibly low, barely touching 5% through the 1970s. Even during the dizzying heights of the 1980s bubble economy, a period of unprecedented domestic prosperity, foreign investors were, surprisingly, net sellers for much of the late 80s, with their share dropping significantly from 8.8% in 1983 to a mere 4.1% by 1987. At the same time, domestic Japanese business corporations held over 30% of the market, effectively owning each other. But then came the lost decades, a prolonged period of economic stagnation and deflation from the 1990s onward. This era challenged Japan's traditional economic model, exposing its vulnerabilities and eventually opening the door for a fundamental rethink. So, what triggered this dramatic shift? Why, in recent years, did the world's most powerful investment funds, sovereign wealth funds, and even legendary investors like Warren Buffett suddenly look to Japan? The catalyst was Abenomics, introduced in late 2012, a bold economic strategy aimed at revitalizing the stagnant economy through monetary easing, fiscal stimulus, and structural reforms. But the real game changer came with significant structural corporate reforms. The Tokyo Stock Exchange, for instance, began explicitly pressuring listed companies to improve their capital efficiency and profitability, particularly those persistently trading below their book value. This sparked a wave of corporate activism. Japanese companies, long criticized for prioritizing stability over shareholder returns, started changing their tune. We saw record share buybacks and increased dividends in 2023. This newfound focus on shareholder value was a massive green light for international capital, signaling a more investor-friendly environment. Several other factors converged: a resilient economic recovery post-pandemic, the long-awaited return of inflation, and rising wages. Japan was no longer seen as a stagnant economy. Its stock market offered genuinely attractive valuations, with the Topix index often trading at a discount compared to its historical average of 14 times forward earnings, recently closer to 12 times. The weakening yen also played a significant role, making Japanese assets more affordable for foreign buyers. And let's not forget the Buffett effect. When the Oracle of Omaha increased his stakes in major Japanese trading houses, it sent a clear, undeniable signal to the rest of the investment world. Japan was open for business. Even domestic initiatives like the new tax-advantaged NISA program, encouraging Japanese citizens to invest in stocks, indirectly support the market, creating a virtuous cycle of investment. But Japan's story, while unique in its trajectory, is part of a larger global trend. In a world increasingly interconnected, the ownership of national wealth is becoming truly international. Take the United Kingdom, for instance. As a global financial hub with an open economy, the UK has long seen substantial foreign ownership. According to the Office for National Statistics, overseas investors held a staggering 57.7% of the value of UK-quoted shares in 2022. That's more than half. This figure has consistently been above 50% for many years, driven by London's role as a financial gateway, attractive dividends, and a history of privatizations that welcomed foreign capital. Then there's Germany, Europe's largest economy. The Deutsche Bundesbank reports that non-residents held 39.6% of shares issued by German companies at the end of 2023. This percentage has steadily climbed from around 20% 2 decades ago, reflecting Germany's robust industrial base, its export-oriented economy, and its attractive valuations within the stable Eurozone. Unlike Japan, which only recently began to fully open its corporate governance, the UK and Germany, with their longer histories of open. Markets and strong corporate governance standards have seen this internationalization unfold more gradually, yet profoundly. These examples underscore that the flow of global capital isn't just about seeking quick profits, it's about deep-seated economic integration. The implications of this silent takeover are profound, not just for Japan, but for any nation experiencing it. Firstly, it marks a significant shift in corporate landscapes. In Japan, it's challenging decades of insular cross-shareholdings. In the UK and Germany, it means companies are highly sensitive to the demands of a diverse global shareholder base. This increased foreign presence is pushing corporations across borders towards greater transparency, better capital allocation, and more shareholder-friendly policies. It's forcing them to evolve, potentially unlocking immense latent value and making them more competitive on the world stage. While foreign portfolio investment can be volatile, following market trends, foreign direct investment, FDI, can bring new technologies, management practices, and competitive pressure, ultimately benefiting economies through increased productivity and innovation. For instance, the Japanese government is even expanding FDI review to secure supply chains and mitigate technology leakage, showing their awareness of the dual nature of this flow. Globally, this trend also means a greater exposure to international economic cycles. If foreign investors pull out, local markets can suffer. However, it also means a deeper pool of capital for growth and development, fostering stronger economic ties between nations. Comparatively, even the United States, the world's largest economy, sees significant foreign ownership. Foreign investors hold roughly 17% of all U.S. equities, totaling over $18 trillion. This isn't an isolated phenomenon. It's a fundamental characteristic of today's interconnected global economy. This rising tide of foreign ownership, while often celebrated as a sign of global integration, is a double-edged sword for the nations involved. On one side, the benefits are substantial. Firstly, it brings much-needed capital infusion. Foreign investment provides a deeper pool of funds for companies to grow, innovate, and expand, far beyond what domestic savings alone might offer. Secondly, it often forces improved corporate governance. Foreign investors, particularly large institutional ones, demand transparency, accountability, and better returns on equity. This pressure can push complacent domestic companies to modernize, become more efficient, and align their interests more closely with shareholders. We saw this directly in Japan's corporate reforms. Thirdly, it enhances market liquidity and efficiency. Foreign investors typically trade more frequently than domestic ones, making markets more dynamic and efficient, which can attract even more investment. And finally, it can foster innovation and technology transfer. Foreign companies, or foreign-owned companies, often bring new technologies, management techniques, and global best practices that can spill over into the local economy. However, there's the other side of the coin, the potential drawbacks. Perhaps the most significant concern is market volatility and capital flight. Foreign capital is often seen as hot money, quick to enter, but just as quick to leave at the first sign of trouble. This can exacerbate economic downturns and destabilize local markets. Secondly, there's the perception and sometimes reality of a loss of national control over key industries. When foreigners own significant stakes in strategic companies, decisions might be made that prioritize global shareholder interests over national economic or social priorities. Thirdly, foreign investors might push for a short-term profit focus, sometimes at the expense of long-term sustainable growth or investment in research and development. This contrasts with traditional Japanese corporate culture, which often prioritized long-term stability and employee welfare. And finally, there's the issue of profit repatriation, where profits generated within a country are sent back to the foreign investors' home countries, rather than being reinvested locally. Navigating this balance between the benefits of global capital and the potential risks to national interest is a complex challenge for governments and businesses worldwide. So, what does this increasing foreign ownership mean for the future of national economies? The trend suggests a continued, perhaps irreversible integration into the global financial system. As corporate reforms deepen and attractive valuations persist, countries like Japan, the UK, and Germany will likely remain magnets for foreign capital, particularly as their stable geopolitical positions attract investment amidst global tensions. This dynamic interplay between domestic restructuring and international investment is reshaping economic identities worldwide. It's a testament to nations adapting, reforming, and opening their doors to global forces in pursuit of renewed growth and efficiency. But it also raises fundamental questions about economic sovereignty and national control, and how each country chooses to balance these competing forces. The story of these stock markets isn't just about numbers. It's about nations evolving, embracing a new chapter, where global capital plays a pivotal role in their economic destinies. It's a powerful reminder that, in today's interconnected world, ownership is increasingly global, and the lines between us and them are blurring, for better or worse. Is this a sign of global strength and interconnectedness, or does it raise concerns about national control? What do you think about the silent takeover of global stock markets? Let us know in the comments below.